Thank you, Neha, for an exhilarating session. And hello, everyone. I'm Ranjana, and we are going to meet again and again for the next 5 days. Hope all of you are having a great time in the India Impact Investing Week. There's lots more to come, so stay tuned. While we looked at how impact investing has evolved during the current times across the globe in the previous session, we now come to another illustrious panel comprising of veterans of the Indian impact investing industry to trace the journey of impact investing in India. Welcome all to the session, India Impact Investing Perspectives, the Past, the Present, and the Future. Let me take a minute to introduce Mark Khan, who's going to moderate this panel for us today. Mark is co-founder and managing partner at Omnivore. Omnivore is a venture capital firm based in India which funds enterprises building the future of agriculture and food. Mark co-founded Omnivore with Jinesh Shah in 2010. Previously, Mark was the Executive Vice President, Strategy and Business Development at Godrej Agrovet, one of India's foremost diversified agribusiness companies. Mark is also on the Capital and Advocacy Subcommittee of IIC. Over to you, Mark.
Thank you very much. It's a great pleasure to be here. Prabhav is off to an amazing start, and we have a terrific panel here today talking about the past, the present, and the future of impact investing in India. I think the context for this is India has a large base of low-income customers, a strong technology culture, and a vibrant entrepreneurial ecosystem. And as that's played out over the past decade plus, we've seen that India is almost an impact laboratory for the world and an incredible destination for impact capital. We've put together a world-class group of panelists today to share their thoughts on where we've come from. History is going to be a big part of this panel because there's been a journey that we've all been on. And I think it's worth recapping what our lessons are from that. We're going to talk about where things are today in India with respect to impact investing and where we're going in the future. As I've already been introduced, I'm going to turn things over to the panelists to introduce themselves. And once we're finished with those introductions, I've asked everyone to talk about both their history as impact investors as well as what they're doing in their current roles. Then we'll launch into questions for each of the panelists. And hopefully at the end, we'll have about 10 or 15 minutes where we can take questions from the audience and address them. But I would ask that they be addressed to specific panelists. So we're going to start with Srini Nagarajan at CDC. Srini, over to you.
Thank you, Ranjana. Thank you, Mark, and thanks all colleagues, most of whom I know very well. I'm Srini Nagarajan. I head CDC for Asia, which for us is defined between the SAARC countries and Myanmar. We don't go beyond that, really. Personally, I have been with CDC since the mid-90s in Africa, in Asia, and with our headquarters in London, really. As most of you probably know, we are 100% owned by the British government, and now through the Foreign, Commonwealth and Development Office, that's what we call FCDO, really. As you also might know, we invest the British taxpayers' money in these markets, in both Africa and in Asia. CDC as a history has been in India for over 30 years and has pioneered path-breaking deals in India. Some of the very pioneering deals during the mid-90s, early 2000 are still there, which stands the test of time. In our world of investing, we always strike a balance between being developmental and commercial. And generally, we don't put our commercial goals ahead of our developmental goals. Just as a background, we have two pools of capital we invest from. One is the growth, and the other one is the catalyst. Growth is where we invest at scale, and catalyst is where we do much more transformational deals, where the development impact is stronger, but the path to profitability could be longer, and our returns could also be, sub-commercial. In addition, I think CDC is a unique DFI to have established platforms like IANA in India for utility scale renewable and now diversifying further. We also have a platform called MedAccess, which provides volume guarantees to pharma companies and is an innovative social financing company, committed to expanding and accelerating access to life-saving medicines, vaccine, and diagnostics in both South Asia and Africa. These are entities which are owned by CDC. And the third entity is called GridWorks, that is more focused on Africa, which is more on the electricity networks, really. So across the South Asian region, we have around $2.5 billion invested across funds and capital partnerships, equity and debt across 6 sectors. As just to be very clear, we invest in opportunities where our capital is additive and our capital remains relevant, and we are very sensitive to crowding out private capital. Crowding out private capital, on the one hand, we can't be supporting fund managers, on the other hand, we crowd them out, is completely counterproductive, really. We have a lot of history of pioneering funds in our markets, and as an LP with a deep record of having succeeded and helped a number of funds over the last 15 years plus unsuccessfully. As one of the leading LPs in the market, and also in the area of direct investing and also debt, we always make sure that our capital stands out and is distinguished, and we keep impact as one of the foremost. I mean, you must understand that we have pushed the boundaries on impact, and we keep pushing the boundaries every time we invest, because we want to stand out, we want to be in the forefront of our investing. Additionality is classified between value additionality and capital additionality. Capital additiveness is where in India is slightly harder because of the fact that there is a lot of capital always available in the country. Value additionality is what we bring to the table specifically during our investment, and what makes us much more distinguished as opposed to a classic commercial investor. We are much more complementary to a classic commercial investor. Mark, let me stop there, and I'll probably answer a few other questions in the next sessions, and I'll give a chance to others.
Absolutely. Thank you, Srini. Now turning things over to Ruchira from IFC.
Thank you, Mark. I'm Ruchira Shukla, and I am the Disruptive Technologies Lead for South Asia at IFC. IFC is the private sector arm of the World Bank Group. And as private sector arm, we have been investing for the last 60 years in private enterprises to deliver both impact and financial returns. We have invested in sectors such as infrastructure, manufacturing, agriculture, services, which includes retail and hotels, etc., financial services, technology, media, telecom, and over the last decade, we've been very active investors in early stage technology companies. In my role as the lead for disruptive tech, I look after the equity investments we take in early stage startups, VC funds, as well as co-investments that we do with venture capital funds. We measure impact across our investment portfolio in terms of the jobs that are created, the students that are reached, that are patients that are served through health services, the taxes that get paid to the governments where we are present, as well as gender and climate. So there's a whole range of parameters that we monitor and track through the course of our investment cycle and beyond. We work with our portfolio companies to make sure these impact metrics are realized. We also focus heavily on working with these portfolio companies to help grow them in order to bring financial returns. So it's a double bottom line focus, both impact and financial returns. Our check sizes range from very large checks that we do in what we call our mainstream department. So in sectors like infrastructure, etc., we've done 200, 300 million kind of investments. In the early stage tech world where I look after, doing early stage investing. So it's typically in the range of 5 million to about 15 to 20 million. Active on boards, and want to do the right thing. So we help these companies grow. We also do a lot of ecosystem building. So we work actively with governments on ensuring that the enabling policies are put in place. So forward thinking on policy and influencing government action to support private sector development. I'll pause there, Mark, and hand it back to you.
Thank you very much, Ruchira. Now shifting to Jaap from FMO.
Thanks, Mark. Yes, I'm Jaap Enking. I'm the Director for Private Equity in FMO. I'm for 20 years already active for FMO. Before joining FMO, I worked for Deutsche Bank. In my role, different roles in FMO, I was active in different regions, among others Latin America, Africa, but also Asia and also Eastern Europe. So I've seen a broad spectrum of the universe in impact investing. I think FMO and my team is managing a portfolio of in total 2.4 billion in equity investments. And of that 2.4 billion, 300 million is invested in India. So India is a pretty important market for FMO. Originally, we invested a lot in financial sector funds. Through those funds, we made some co-investments in some MFIs in India. But we also invested in some mezzanine funds where we were looking after and looking for investments in more rural areas of India. And I also understand that as being impact investing. We have a focus on financial sector development, MFIs, but also non-banking financial institutions, but also focused MBFCs in the agriculture sector and the energy sector. Aside of the financial sector, we do look after the agriculture sector and the renewable energy sector. And I think pretty new, but we also started a venture capital program last year, which is a program of 200 million to be invested in disruptive technologies, also focused on the three mentioned sectors. Impact for us is important, but it's also a wide, you can say impact. What is impact exactly? Well, we do measure, and I think Srini also mentioned something about how do you actually measure impact. So we also look at the jobs created, but we also measure the greenhouse gases in our portfolio, and also the number of SMEs we reach out to via our investments in the financial sector. So we very much focus on those metrics. And I leave it to that, Mark, so I give room to others as well.
Thanks, Jaap. Now to Geeta from MSDF.
Thanks, Mark. And yes, I must say, Prabhav is off to a great start. I attended the first few sessions, so congratulations to the entire IIC team. Just about myself, yes, I'm Geeta. I'm responsible for the Michael and Susan Dell Foundation's operations in India. The foundation is the personal philanthropy of Michael Dell, and it was set up in '99 with the objective of improving life outcomes for children and youth living in urban low-income communities. The reason I'm spelling that out in this panel is because that introduction is a little bit different from the others. We were set up with an impact objective. It is a philanthropy. And we operate in 3 countries, one of which is India, the other 2 are South Africa and US. In India, the focus is on education, livelihoods, and financial inclusion, all towards the objective of improving life outcomes. And while we are a small foundation, given the need and the scale of the problem in India and the 3 sectors that we picked up, we did not want to be small in our ambitions for India. So we said we will, the mantra for our approach is to say, let's support scalable, sustainable impact. Let's be laser focused on the target segment we want to serve. Let's be laser focused on the impact or the quality of the work that we support. But let's be flexible with the funding tools that we use. Let's be flexible with the partners that we engage with in order to drive this. So at the foundation, we do grants to nonprofits. We work with state governments on certain reform projects. So we work with consulting firms. And we also work with social enterprises. That's where our impact investing portfolio comes in. And really the genesis of impact investing within the foundation was to say that markets can definitely provide a large-scale, high-quality solution for our target segment. We really need to use our capital, which is limited, to catalyze market shifts to either certain geographies, certain target segments, certain products, etc. and to and that's a large part of our impact investing portfolio, which I say would be in the catalytic bucket, and Srini referred to that. And we also said, let's use impact investing to create, or to create blended instruments which can bridge gaps in the market. So we do use our impact investing tools in things like impact bonds, pay for success, etc., which again ride on market instruments, and we can talk about it. Just as an example of our impact investing, we started operations in India in 2006, and we started impact investing in India in 2006. And our first portfolio in impact investing was around urban microfinance, because we said, rural microfinance had proven its viability. It was attracting a little bit of interest. I mean, compared to these times, I would say it was a trickle then. But there was a high risk associated with urban microfinance, and the need was as high. So we supported a few urban-focused microfinance institutions as, the first level of equity investors. And I do see some of our co-investors in the early years alongside on this panel. And in fact, I may be wrong, but I think there is one institution where the entire panel has invested, Ujjivan, right?
Yeah.
Yeah, other than you, Mark. But yeah, so I mean, it's been a long journey. It's been a slow journey, but it's been an exciting journey to ensure that that markets do evolve ultimately to serve the target segment that we would like to, and then they continue to service it sustainably. Today, our impact investing portfolio is in India, it's about $100 million. It's spread across some 40 investments, including a few seed funds. A large part of it is equity, but we also do debt, and now post-COVID more guarantees, because we realized that was the product. We've had, I would say, a fair share of exits, but most importantly, I would say the impact of each of the institutions and the continued sustainability of impact is something that does make us proud. And it will, each year, I think together they impact about 20 million children and families on an annual basis. So let me pause there and hand it back to you, Mark.
Thanks, Geeta. And now Sandeep Farayas from Elevar, please chime in.
Thank you, Mark. Geeta, I think that was an incredible point that you made, that I think with the exception of Mark, all of us have backed this one institution at different stages. So Prasad, when he wore an equity cap and not a debt cap. So, but it also demonstrates how old we all are in the impact space, frankly speaking. Many of us probably started off before impact investing was called impact investing. Anyway, good evening, good morning, everyone. My name is Sandeep Farayas. I'm one of the founders and managing partners at Elevar Equity. We invest in India and in Latin America. These are our two geographies. We today manage about $287 million through 4 funds. Broadly, if you were to calculate it, 2/3 of our capital is coming to India and about 1/3 into the Latin American context. We are the consummate early stage investor in terms of the time we enter a company. We are very comfortable with even startups. And I think over the years have been just very proud of having backed institutions like Ujjivan and Samunati and Vistar within the Indian context. But I think in terms of strategy and approach, we spend an incredible amount of time in the field, understanding needs, aspirations, the wallet of the customer. Some estimates that up to 10 to 15% of senior leadership time actually goes in that interaction. And from there really comes the investment thesis that we want to back. Now, the sectors that we focus on, while we don't think sectorally and our funds are not raised sectorally, we really are focused on meeting the needs of low-income communities. But we started with financial inclusion. The other sectors that we've invested in are education, agriculture, and I would say the broad MSME space. These are the 4 sectors, particularly in the Indian context. And between India and Latin America, we've invested now in 38 companies. Like I mentioned, we go in early. But in terms of capital, just short of 30% of our capital has actually gone in at the early stage. But then because we reserve fairly aggressively as far as the portfolio is concerned, the balance has actually gone in at kind of a growth stage. That would probably be the best way to describe it. Essential services is our focus. So no rocket science there, no innovation in the product. It's things that all of us can take for granted. But I think the approach is fundamentally to ensure that is there a distribution strategy which can deliver the product or the service affordably to low-income communities, which essentially means then scale becomes the imperative from a commercial return standpoint. We're a partnership which has worked together for over 12 years. And I think some of the statistics that we're particularly proud of is the equity leverage. So the co-investor capital that's followed us into our companies, which is so about 180 odd million of our capital has gone in, and over something like 1.2, 1.3 billion dollars of capital has come into our portfolio companies after we've invested. We've reached over 30 million households, and one of the key things we measure is what we call customer business value, which is what is the true economic activity at the customer level that these companies have actually helped. And that's at the best estimate, it probably is higher, but at the best estimate is in the mid-teens, low to mid-teens $billion of economic activity. Our loss ratio has been less than 15%. And I think if you ask me, I think Srini put that framework very nicely about the value addition in addition to the capital that we provide. I think for us, the thing I often articulate is I think it's the loneliness of the entrepreneurial journey. So we as investors, I think all of us on this panel need to constantly adapt ourselves to ensure that we are there for our entrepreneurs and ensure that they can build large successful companies. So that's been the Elevate journey through 38 companies in India and Latin America, over 15 years actually. Thank you.
Thanks, Sandeep. And last but certainly not least, Viswanatha Prasad from Caspian. Viswanatha, would love to hear about your story.
Sure, Mark. Thanks for this opportunity. We started about 16 years ago. As a firm that we are passionate about. Bringing private and developmental capital to entrepreneurs in the impact space. And we started, I would say, first decade or so, we spent really working on financial inclusion. So, like many of us here started with microfinance, but then we did do, deals in affordable housing, some technology deals, early adoption of technology in financial services. We invested, like Sandeep said, across, through the growth of these enterprises. About 5 years ago, we started, after we successfully exited, we've returned close to $200 million to our LPs, in the first 10, 12 years of our investing. And the last 5 years, while we continue to invest, in equity, but we've kind of defocused a bit on financial services or financial inclusion per se. So we still do some interesting transactions. We've tried to take those learnings of the first decade or so into other sectors, which is food and ag, clean energy, health, education, and use a variety of instruments. Not only equity, but venture debt, early stage debt into these companies. We worked with over 100 entrepreneurs in the last 15, 16 years. And as a team, we are close to 50. We're a 50-member investment team, investment and operations team. Really, so we invest only in India and very passionate about impact. So we are a B Corp. We are a 5-star rated Gears fund, and best for the world honorary from Gears. The reason I say that is that we are as a team very passionate about bringing some trying to address or solve some of the harder problems with an ambition that if there's a business idea that is both impactful and sustainable, it should really not go without expertise or capital. That's really what we're trying to do. We are small relative to what others in the panel have deployed. So we've deployed about 100 110, 120 million in equity and about 75 million or so we manage out of our debt and venture debt pool. Yeah, so like I said, we're very proud about the entrepreneurs we backed and the businesses we've scaled, and also we for the other mainstream investors, which was a big question in the first several years of investing was, okay, these are all great ideas, but where will you actually get exits? So we're very proud of having a very as a impact investing community. I think we have an enviable track record on exit and returning capital compared to a lot of mid market funds. I think as a group we don't talk about that enough, but I think we should bring that as a focus, because it's one of the markets where I think very successful investments have led to IPOs, have led to exits for investors to see the return of capital. Yeah, so I'll stop there, and yeah, so I'm sure some more conversations will come up as we discuss in the panel.
Most certainly, Viswanatha. We're gonna launch into questions right now, and we're going to start with Geeta. Geeta talked about the fact that impact investing since, what was it, 2006? And so I think we're going to make you our historian for a moment, and let's talk about the history of impact investing in India. Can you share some thoughts on how things have changed from the early days of investing in MFIs to where we are today with, a multi-sectoral tech-driven approach to impact?
I must say, Mark, this has been the most complimentary panel. I'm hearing words like veteran, historian, the old timers. So yes, I think that's a good way to segue into the history of impact investing. And I must say that yes, while some of the likes of us emerged on the scene in India in 2006, impact investing dates back much more. In fact, we had Manoj Mittal from SIDBI a couple of hours before us, and he talked about, in some ways I feel whether it was SIDBI, IDBI, IDFC, these were all very strong impact enterprises which made market models work. And I know some of the DFIs in this panel were supportive of such institutions. So I would say, there was that part of impact investing. And then between 2000 2005, we had a lot of state governments setting up, their venture fund arms, which were also supposed to create impact. So there was that side of it. And then I would say it is impact investing, as we would like to call it. I had termed ourselves as new kids on the block till you called me a veteran, so fine. We will stick with that terminology. So yes, I would say, to your point, between 2005 to 2012, a large part of impact investing was almost dedicated to microfinance. The first few years were much fewer funds taking the risk capital approach, the almost like a VC with an impact approach, providing early stage capital. Between 2009 to 2012, we not only saw other impact funds emerge, but we saw mainstream capital validating some of the microfinance investments made, which did give a boost to the sector. Not just to microfinance, but to impact investing in general, and saying as a concept, it had proven that you could actually get social and financial returns. Of course, we weathered the crisis in between and all, but those were side distractions. And I think almost in parallel came up other financial inclusion, whether it was MSME or micro mortgages, etc. I would say the multi-sector shift really started happening, in the time range of 2012 to now. It may have taken a spurt in 2015, 16, and I do think like Geo has again been a great, within microfinance, I would say priority sector lending was a great support. When I look at some of our tech-led, tech-enabled investments, I would say Geo and just the smartphone revolution has been a great supporter. Today I would say if you look at the last 2 years, there's been almost a 50-50 split of impact investments between financial inclusion and non-financial inclusion. So I think we've reached a healthy balance. We have seen that some sectors have taken longer to prove results on scale and viability than financial inclusion. So I think, we're getting into sectoral nuances, target segment nuances, all of that. But as such, the concept of impact investing is now much broader. I would say it's significantly supported by technology. So, and therefore becoming more and more mainstream because technology is helping democratize access, it's helping improve margins, retain quality, etc. I would just say as we move into that phase, it's important for us to start classifying ourselves as, I think Srini pointed out, catalytic capital, or deep impact capital. So, we only work with a certain target segment of population, and that may not be the 70 to 80th percentile, but it's the 20th to 30th percentile or whatever it is. I mean, our low income segment in India is fairly large, or it may be sectoral capital, like you are an agriculture fund, or it may be, growth capital or market capital, which is a listed entities. But I think the more we start segmenting and, categorizing ourselves, we will add more clarity to the concept of impact investing and make it further widespread and actually ensure success. Let me just pause there, and we can come back to some of these issues later.
We'll certainly have more questions for you. So the next question is for Srini Nagarajan from CDC. So Srini, as one of the leading LPs in India, what are your views regarding the strong growth of India's impact investing sector, both with respect to new players and overall funding flows? And what are the positive and negative trends that you're seeing?
Thanks, Mark. It's quite enriching for me to listen to others. Private equity capital, if you look at what has been raised between 2006 and 2018, more than 50% of the capital raised has been allocated to 14 fund managers out of an estimated 162 active fund managers in India. I mean, CDC, for example, had committed $1.8 billion to 56 funds since 2004. And equally, our strategy has worked, has also evolved over the years. But if you try and look at, the overall, McKinsey study, India impact investment has been growing at a CAGR of around 14% per annum. And as per their analysis, the industry will go up to around $7 billion by 2025, principally driven by sector diversification beyond financial inclusion into education, healthcare, and agri sector, which is expected to grow by around 20% over the next over the next years. Decent financial return. Financial inclusion, clean energy, and agriculture sector have particularly delivered superior returns in the broader market, and also demonstrable impact as a result of all this, really. So if you try and if you try and look at the world of impact investing, if you look at 15 years back, I remember when we talked about ESG, what we call environmental, social, and governance, it was very unique in a world. Were very unique to GPs for us to try and explain what an ESG meant. And as a DFI, CDC pioneered in many of these private equity platforms and the impact platforms. But that is now beginning to look like a norm. If you don't follow in ENS practices, you won't be able to raise any money from any LP internationally, given where we are on climate change. So I think what we have done at CDC is to push the boundaries, as I said earlier. And with our commitment, for example, with our commitment to climate change and our alliance to Paris Accord, where we are heavily focused on the area with a commitment towards net zero emission by 2050. So, for example, again, for 2021, we have set a target of climate change for finance target of around 30% of our annual commitment. So that is really pushing the boundaries as far as the overall impact. Climate. One theme about climate, it cuts across various themes. It's just not utility scale. You talk about commercial and industrial, you talked about smart metering, you talked about microgrids, talk about food and agri. Every segment of it, climate plays an important role, really. And beyond this, as CDC, we are definitely focused on gender, given our commitment to 2X challenge, job quality, human capital. These are the various components of it, what we are trying to bring to the various companies. And I feel that most of the impact investors resonate pretty well with all these challenges which we have posed in front of ourselves, really. Second important thing is that, look, there is a growing evidence that more inclusive investments and financial performance are quite positively correlated, as opposed to probably contrarian feeling where some investors could have. They're actually quite positively correlated. In our portfolio, impact investors have delivered value for us. And they've delivered positive value, and they've also, in the process, and as they grow further, they're more and more, they're also pushing the boundaries towards delivering greater impact. The third point is, I think the technology and innovation business models are opening up new opportunities for the world, for the impact investing previously considered uninvestable, or which has actually been characterized by very low returns, really. As we move forward, I think we are looking at three main areas: inclusion, productivity. Productivity, I mean really reducing poverty by putting more money in the hands of people, jobs, livelihood, and making them, and also reducing the cost of services and increasing the availability and quality. And of course, I talked about sustainability, which is more the climate change side of it, really. So from a CDC standpoint, we are really looking at funds that are impact driven or sector focus driven that really deliver impact beyond, of course, our world of investing and where we see, really. So Mark, let me pause there.
Thank you. Thanks, Srini. So the next question is for Ruchira. From your vantage point at IFC, what are the sectors where India is showing the most deep innovation and technology leadership for large-scale impact? And in which sectors are we lagging, if we're going to be honest?
Thank you, Mark. So I agree with the remarks made earlier that the impact investing game for India has now gone beyond just microfinance to include other sectors, as other sectors scale and can deliver on the impact metrics we all care about. So let me talk about some sectors that are doing very well, have done well so far, and actually even in the current environment are seeing a lot of tailwinds. One sector that stands out is health services. And COVID has been a big sort of catalyst in making that happen, because we've realized that we need digital health services. None of us wants to walk into a hospital at this time. None of us wants to walk into a pharmacy at this time, right? So remote healthcare is the need of the hour. And so platforms that had already started seeing that and preparing for that and building for it are the ones that are seeing a lot of interest from investors and customers at this point. This includes things like teleconsultations. So we are investors in a platform called 1MG that actually is building India's integrated digital healthcare platform. So it includes teleconsults, e-pharmacies, patient support platforms. Same thing with e-pharmacies. So a lot of the e-commerce initially started with the regular groceries, food, apparel and stuff, but to crack the pharmacy supply chain was difficult. But now you see a couple of emerging leaders, and I would say between PharmEasy and 1MG, there's pretty much the leaders in this marketplace in e-pharmacy. The other areas I hinted upon, platforms like 1MG are also trying to do patient support solutions where they partner with pharmaceutical companies in delivering a comprehensive solutions to chronic patients. This includes drug administration, counseling, an app-based platform where you can track the patient's performance and monitoring the patient's condition. So there's a lot of that coming into play, which were new solutions never existed before. And then there is the use of AI, where deep tech meets healthcare services, where AI is now coming to the fore and helping in solutions like differential diagnostics. So if you layer on AI on a teleconsultation platform, you can actually use a lot of that patient information you gather to then come up with 2 or 3 differential diagnostic conclusions that are then shared with the doctor for them to make a final call. So the final decision and diagnosis still lies with the doctor, but the AI allows them to look at that initial mass of information they're getting from the patient, distill out the stuff they need, and think of a particular hypothesis on what may be happening. That increases the doctor's productivity. There are also productivity enhancing solutions in the lab, in the pathology area, where you can have AI based solutions for reading blood samples and being able to give a report that then the pathologist can validate. So a lot of AI and deep tech in health services. The other area that I think is seeing a lot of tailwind now is education. We are investors in Baiju, and Baiju actually did a lot when COVID struck on making sure that students keep learning. Because suddenly we felt, parents are home, they're working from home, kids are home as well, and not studying at all. And so, Baiju's first made, so that's just for those who don't know, Baiju is basically a K-12 supplementary education platform that provides video-based learning and personalized learning paths for students. And as an immediate step, they made parts of their app free for people so that students could start downloading the app and learning. And then they moved on to doing live classes, online live classes. So think of, the whole nation studying fourth grade math at 9 a.m. in the morning, right? So it's like this massive virtual school that came into being because it was the necessity of the hour. So a lot of innovation, I think, in edutech. I'm also seeing digital classroom solutions being put together because now classrooms are thinking, how do we ever restart? To restart school means you get kids together in one place, and there's, where is this social distancing going from there? So virtual classroom solutions, I've seen one, and actually that came out of Southeast Asia, but had a regional ambition to grow into India and other countries in this region. The other space is agri-tech. I think agri-tech we have seen.
Hugely relieved to hear you say that, ma'am.
Yes, I knew you would prompt me if I didn't. Agri-tech is huge, and I think even 3 to 4 years ago, I wasn't seeing the kind of tech stuff that I'm seeing in agri-tech now, where I've seen solutions that can take a picture of a plant and use AI to tell you what kind of disease is going on there and link the farmer to a particular retail outlet where he can buy the appropriate medication or solution for that plant, right? So those kind of solutions to platforms that allow farmers to buy their inputs, platforms that allow them to reach markets by doing output, pricing and enhancing reach. So a lot of interest in agri. I think the unfortunate thing with that, Mark, as I'm sure you know, is that these agri-tech assets are becoming very expensive. So I'm in the midst of trying to close a couple of deals and I'm saying, wow, this valuation surprises me, but that's because every investor's sort of realized that this is the space to be. On the place where I think I'd like to see more is SME digitization. So IFC had started backing some B2B platforms because they would force SMEs, or actually encourage SMEs is the better word, to move from paper-based processes to digital processes. I think we've made some progress there, but a lot needs to be done because I think on SME digitization, at least the platforms we've seen still suffer from a lack of access to working capital. So it's not sufficient to take these SMEs from a paper-based world to a more digital world. With that comes other solutions. So it's now that you're able to track the SMEs transactions better, would you be able to deliver access to finance? So some of those platforms have not been scaling because of lack of working capital support. So I think there we could do some more. The other area which I think is deep tech but relates to the healthcare services area I was talking about earlier is precision medication. I think precision medication is going to be the future. And while I see that the landscape in India has evolved, I've been tracking it for the last 3-4 years. There were 4-5 good companies a while ago, but right now I would say there's 1 or 2 maybe emerging at the top. And so investors can do their bit to support more companies coming into the space and growing to a place where they become leaders in this space. I think India could do a lot more. We could learn from other countries that are ahead of us, including US and China. India is the right market for good genomics platforms, but we haven't seen enough emerge in that space yet.
Yeah, I mean, that's sort of a general thesis of ours that India is punching above its weight digitally, but in anything life sciences related, there's a lot of work and need for catalytic capital. So next question goes to Sandeep from Elevar. So Sandeep, given your global footprint, right, straddling South Asia and Latin America, what are your views of India's impact sector and entrepreneurial ecosystem relative to other emerging markets that you track?
It's an interesting question, Mark. And so, I mean, to answer that in many respects, just to keep in context, at least from our standpoint, the focus is on essential services. And I think that's a very important context to keep in mind. In 2008, 2009, there was, a conversation that I was part of, and there was this sense that India could lead the world when it comes to business models that address issues of inclusion across multiple sectors. And I think India as a country has perhaps done that. But let me give you the breakdown of why I see that has perhaps happened. We invest in India and Latin America, and in terms of the quality of the entrepreneurial talent, there's absolutely no doubts that both the markets are extremely vibrant. If you take the second aspect is capital availability, I think that's where India makes a difference, because the layers of capital and the diversified pools of capital, both on the commercial and the impact side of the equation, in India is just unparalleled in that sense. And I think, Geeta referred to Jeevan, where all of us were investors in that one company, but there were many commercial sources of capital that were also available. I made a reference to the $1.3 billion of equity that has been raised in our portfolio. The interesting statistic on that is 75% of that capital actually came from commercial sources and 25% from self-declared impact sources. So if you pull back and you really think about India in that context, the other framework we use, we think about all companies from 4 stages: the distribution economics and how do you prove that, how do you build the organizational platform, and then how do you scale and grow and finally exit, and really think about it in that construct. I think that's where India, you have the time, you have the luxury because of the size of the market fundamentally compared to other markets, where in the Latin American context specifically, we necessarily, to get the same kind of return profiles or the expectations, will need to do multi-country plays, while in India, you can actually just build something at a very, very fundamental level. Let me add nuances now to this very, very quickly before I hand back to you. Distribution strategies. I think India can lend itself to what many of us call the B2B2C kind of strategies, using MSMEs or other kinds of aggregators in the middle to reach low-income communities at the end. But you don't necessarily you've talked about technology already and others have referred to that, but that's not the only way you can build that non-linear distribution in India. I think community dynamics, the strength of community dynamics within low-income communities is another way that we can do that within an Indian context, which I think is somewhat unique. And so those are additional factors that one has to keep in mind. The final point that I'll make is, and Srini made a reference to that, is there is a positive correlation between impact and returns. And I think at least for us, between both those markets, there's no ambiguity that there is sufficient data to demonstrate that. So if I were to summarize quality of entrepreneurial talent, I think there's no difference. I think it's great on both sides of the world. I think business models, India has the advantage because of the size of the market, but fundamentally we are able to actually take these business models across markets. In terms of sources of capital, perhaps India has a distinct advantage, and then of course the size of the market. So that's the way I would construct that framework.
Excellent. That's very, very helpful. We're going to kind of continue on the same line of questioning with Jaap from FMO. So Jaap, what are some lessons that India and our impact investing ecosystem can learn from other countries? We've heard about, how large we are, huge market, scalability, but there must be things we can learn from elsewhere. So what do you think those lessons are?
Mark, it's a really difficult question because you started this this question round with saying, India is a thrilling marketplace with a lot of good entrepreneurs, and I can confirm it is like that. So, however, there are always things you can learn. So I will try to give you some good things. I think, first of all, from a government side, I think it's important to create a predictable and stable policy setting. I think that's from the government side very important to allow the private sector to set up business in an environment where you can do the things you want to do as a company, also in the impact investing environment. Then I think as sectors, you also can come together in a setting where you group yourself in a certain sector and create certain levels of confidence to the market, how you can make sure that the environment is such that that all the sector, all the players in that sector can stick to that sector-wide regulation, which is set by the sector itself. And I think an example could be in the microfinance, that you prevent the sector how to prevent over-indebtedness in the sector. Then I think India could also learn by other countries to include more women in boardrooms. I think all the boardrooms I'm encountering, at least 90% is men in most cases. So I think there also a more diverse boardroom is important to also make the awareness within the country that women and men are equal and also should be equal in driving businesses. And then I think one of the things which is currently making business more difficult for foreign entities is the foreign exchange regulation. It becomes more and more difficult to invest with foreign currencies into the market. So I think it's also important to keep the market open for outside investors. We discussed already that indeed the market for impact investors is increasing. Therefore, I think it's also important to attract these investors to India by having policies which makes it easy to invest. I think I'll stick to those examples.
I think they're great examples. They're certainly not an easy to accomplish wish list. There are a lot of people in the government participating in this conference and hopefully listening to some of these concerns. So now a question for Vishwanath. Do we need a more active debt funding ecosystem in Indian impact investing? And how do you see us being able to make that happen?
Yeah, thanks, Mark. So when we, 5 years ago started looking at, the business or the investment opportunity on the impact in the impact space and in the non-financial inclusion sectors, we did see a big opportunity in the debt space, and I'll take a moment to explain why. So let's keep aside the impact businesses for a moment. But all the great innovation ideas that we all spoke about in the panel, from education to technology that Chiro spoke about. So all of these entrepreneurs that are coming in and building these great companies and innovating are by and large first generation entrepreneurs. And if you look at once they build a business model and raise their first round of venture capital or Series A investments, and that's one of the reasons why Ruchira the valuations are so high, and I'll come to that in a moment, is that there's really no other room for them to leverage their equity for quite a long time unless they go into dilutive capital. So if you spoke about the tech platform for SMEs that can do better. So if they can't raise debt, they have to go to the market and dilute their equity. And since they're already first generation entrepreneurs, by the time their business is successful, if you look at our portfolio, in this panel, by the end of the 5th year, the entrepreneur really owns nothing. Especially in capital guzzling businesses, financial services, clean energy, large distributed, B2B2C that Sandeep spoke about. So there is, I think, a role for debt for certain business models that have, proven unit economics, that have clearly demonstrated the viability of the business, and have strong access to capital if required. So if there are certain characteristics that are there in any growing SME, and of course all these are further accentuated in an impact enterprise, then why can't you bring debt into this balance sheet, which is a win-win situation. It's a no-brainer product for the entrepreneur, because she's getting non-dilutive capital, and of course for the investors. Of course, we have to be careful not to load an early stage company with debt. That's also can be a recipe for disaster. But in our estimate, we think that about between a fifth and a fourth of a successful impact businesses that attract all ranges of capital, angel, venture, Series A, can leverage, and will be a great tool to put along with all the other capital and expertise that's there amongst the impact ecosystem, to provide that as a product. Now, how can we make it? So I mean, we need a few things. I mean, one is, if you see the Indian banking system or the NBFC system, while you do have a lot of capital available for micro enterprises, basically it's like it falls off at about $75,000. So if you need a loan without offering collateral, and I'm not talking about micro enterprises, I'm talking about businesses that can scale up, create disruptive solutions to the market. So that's so the market ends there. So you can bring in some technology platform that Ruchira spoke about, but then you need to be necessarily selling to a rated entity. That's when you have access to debt. So it's a smaller and smaller segment if you keep slicing it. So there is this clearly a market that's available, which will, I think, help the entrepreneurs significantly, give them access to non-dilutive capital. Two issues are, you have to use technology to scale up. Even to get that debt out to hundreds of businesses, you need use technology, but you need to use smart technology. You have to understand the business model. You cannot ignore the business model of the enterprise. So it's complex. So it can be expensive to assess without getting you the equity return. So you need scale. And of course, we have to in spite of all this, we have to demonstrate that this is a scalable model from a return and a risk perspective. But I think it's clearly a space for that. And of course, investors love debt, so we don't have a problem of raising capital for this pool. But to get that out for the subset of impact enterprises and entrepreneurs that we want to get to is harder to scale. And that's where I think a combination of technology and an equity mindset, I think will help that scale.
Excellent. All right, folks, we have about 15 minutes left. We've gone well over intended time in terms of responses to questions. So I'm going to treat the next 15 minutes as basically a lightning round. So if you had a 5-minute answer to questions that we had prepped you for, you've got 1 minute. So I'm going to go through a mix of questions here that we've talked about earlier, as well as some questions from the audience. And I would really ask you if you could restrict yourselves to 1 minute. We'll get a lot of information out to people as fast as possible. So the next question is for Srini from CDC. So Srini, what's great, what's good, and what needs to improve about impact investing in India?
Excellent. So, as you know, I mean, from CDC's point of view, we invest in inclusion funds, sector-specific funds, particularly focus on the low-income states of India, and in the VC funds, which are more on the disruptive side, really. And what's unique about impact investing in India is that, as people said, we have great entrepreneurs and ability to scale management teams. Technology is fast changing with our ability to bring down the cost to income ratios. And what's also unique is that, look, we need, I mean, I think there is evidence of exit environment, but we need a more vibrant exit environment in this country. Of course, under COVID-19, we have to provide systemic support to the companies. Final point, I would say, what's great about impact investing in India, it's about the growing, I mean, it's growing very well with a demonstrable record of having delivered good returns. What's good is it definitely diversifying beyond financial services. What needs to improve, we need to create scale at more sectors beyond the conventional FS, really. I think impact investing in India has been largely correlated to financial services, though there are gradual evidences of healthcare, agriculture, and technology growing, which is very good, actually. Let me stop there.
Awesome. Ruchira, next question for you, and we're going to mix things up. We have something from the audience. So how does the DFI approach of IFC contrast with the approach of venture capitalists in the disruptive technology space?
So I think, the fact that DFIs are a lot more balanced in how we think about stuff, and we are more long-term is the biggest difference. We do care a lot more about impact metrics than a typical commercially oriented VC would. But as we have said in the past during the course of this panel, I think focusing on impact metrics, focusing on ENS actually results in a better, more thoughtfully built business that is governed better and therefore can attract better quality talent, customers that are sensitive to the same goals of ENS and impact, as well as investors. And as Srini said, and I totally concur from my portfolio, we're seeing both impact returns as well as financial returns from our portfolio. So I think that the DFI's long-term approach and impact focus approach actually helps to build very sound businesses.
Great. Viswanatha, I've got an interesting question from the audience for you, which is, people are asking, how can impact funds leverage government capital to maximize impact? Would love your thoughts on that.
Okay, in 1 minute. So we have a long track record, see, either government funds or government-directed funds. Srini spoke about the success of the financial inclusion space. It was a combination of factors: ecosystem development, regulation, but a lot of directed money came to leverage these financial institutions by priority sector. I think what will help is, and I was going to say this, that it is great that all of us were invested in one company, and I think it's not a coincidence. It was a very collaborative approach. Today, I think we need more of that, because as soon as you move out of financial services, it's actually even more complex. So I didn't see us, for example, we would have never in the financial services space led an education policy or new agriculture policy that came out in the last few weeks. I don't think we were on the table in any significant way. Maybe individually, as interested investors, we may have been there, given some inputs, but that would have never happened in the financial services space, because we kind of were we were on the table with the RBI, with the central bank, with the federal government, state government. So I think that is, so the short answer is we have to, collaborate even more to get access. And there's a lot of money available there. So, so we just have to be smart about, presenting ourselves and showing our impact. And I think we have a credible track record. But because of the complexity as you move out of financial services, whether it's education or healthcare, it is supremely complex to collaborate, because then our objectives start to diversify. But then I would say more collaboration.
We definitely need to collaborate and need to step up in government interface. Next question, again, lightning round for Yap. What is the overall funding outlook for impact globally as you see it? And do you see greater impact flows going into emerging markets and to India specifically?
Well, there is a lot of money available for impact investing. However, at the same time, also impact investors are looking for return, and maybe not ones where foundations like Gita is representing here, but most real impact investors are also looking for a return. And unfortunately, especially in countries in Africa, we were not able, but also Latin America, we were not able to show the returns as required. And I think Srini also mentioned something specific about the market in India, which is the exit environment. So by investing in private equity, you also need a kind of exit culture and need to bring companies to the market in order to also make your investment liquid. So I think India as well to attract more impact investor capital. However, I think it's for the whole industry very important to also create financial returns, also by exiting the investments at a certain point of time by either a trade sale or a listing.
Yep. No, all spot on. Geeta, lightning round question for you. What does the Indian impact investor, the Indian impact sector need to be careful about? What's flashing red?
Okay, let me try and sum it up in a minute. But yes, first I would say I think we're all talking about digital access, digital, solutions reaching the low income. I think we have to be conscious that there is a large part of our low income segment. I think there are 500 million feature phone users in India. So there is a large part which is getting left behind. So just identifying your target segment. The second is, and I think Srini mentioned it. I mean, yes, the sector has had good returns. Some exits, some still to happen. So I think it has a proven track record on financials, and the market will force the fund managers on financials. If the impact community places the bar high on impact, then the balance will occur. And I strongly believe that finance and social returns do correlate on impact. And I would say is, India has a well-developed capital market. So again, for impact investors, do you want to do more of the same, or should we bring in the additionality factor more and more and just push the boundaries? Again, in the long run, it will yield to better returns. But let's, I would say, take the tougher problems and solve for them and let others follow rather than the other way around.
Mark, if I may allow me to make one point, I just want to say one point that in the world of impact investing, I think the impact fund managers are playing a role, but it's a duty of the DFIs to take on the baton from the impact fund managers and help these businesses scale. Because we got the patient capital, we got the plethora of ability to invest in debt, equity, and mezzanine instruments. I think the DFIs have to step up and play a big role. And that's when we can really help the impact fund managers to play their role. Because they can't invest and scale. It's very difficult for them because they have to manage this portfolio.
Yep, 100%. And it's great to see CDC playing a much more active role doing that. So exciting times. Sandeep, lightning round question for you, very of the moment. How do we see the Indian impact enterprises responding to the challenge of COVID? And what lessons have you learned from your own portfolio at Elevar about resilience?
Well, 2 questions in 1 minute. Okay.
I'll give you 2 minutes. We got
excellent.
A little bit of room.
So I think very often about India, people say is that for every statement that's true, the opposite is equally true. And this is certainly one of those questions where generalizations can come back to bite you, but I'm going to still go forward. I see the continuum as vulnerability to resilience to vibrancy of low-income communities. And I think that's the context. Whether when you dealt with the microfinance crisis or demonetization or any of those kinds of macro issues, and most certainly COVID of late, I think you start to really move from resilience to the vulnerability framework. But I think we should not underestimate the resilience of the customer, and I don't think we should underestimate the resilience of the entrepreneurial talent that exists, and certainly the way the economy tends to respond very, very quickly. If you take macroeconomic data at this point of time in the month of September, you wouldn't believe that COVID existed in this country. Actually, numbers indicate from a power consumption standpoint, from a tax collection standpoint, from consumption indicator standpoint, etc., that we are actually just 5 to 10% off of last August or last September, and very close to pre-lockdown numbers on many sectors which are core essential services within the economy. At the same time, there is a tremendous human tragedy which exists. So what are the lessons? I think for entrepreneurs, I think the crux of the issue is cash is king. It's always king. We created a very simple framework with our portfolio. We said cash, which is equity, to last out 18 months. Debt, if it's relevant to your business. What is the impact on capital and exits? What's the impact on your business model? Recovery trajectory. Pre-crisis view of the portfolio, because the good entrepreneurs are good entrepreneurs in crisis and in good times. And finally, does COVID give rise to a specific opportunity in the context of your business model? So I would say for entrepreneurs on an overall basis, I think it's an excellent time if you want to start a business, actually, to enter the space, because you can really get close to the end customer at a point where we are moving from vulnerability back to resilience, and then hopefully we'll get back to vibrancy.
Sandeep, I love the framework and I love your optimism. I think we all need a dose of that right now. Okay, so we've got 3 minutes left, and I've got a question that I hope the GPs here will forgive me, but we're going to ask this question to the three DFIs on the panel, to IFC, to CDC, and to FMO. So Ruchira had already talked about the fact that some of the valuations in tech-driven impact businesses are getting out of hand. How do we justify some of the valuations that we're seeing today? How do you think about them as investors that have sort of almost a panopticon view of the world in terms of what you're investing in? So maybe let's start with Srini, then Ruchira, and then Yap.
It's a tough question, Mark. Basically, in the world of venture capital investing, it's very hard to adopt the more conventional techniques of what we are talking about. Really, I guess the way we are thinking about valuations in these technology related companies is, you got to come in early. You got to take multiple bets. We are not kind of institutions who can take a single bet at $11 billion valuation. That's not us, really. We got to come in early. We got to take multiple bets, and we got to focus, make sure that 50% of our investments where we take co-investments, where there is a reduction in the cost of services or higher realizations in the hands of producers. If it doesn't meet that threshold, it's not us. So I think the only way for us is to come in with, we have a plethora of around 10 odd VC funds, prospectively 6 to 7 currently invested. We are actively looking for co-investment opportunities with them. That's when we plant the seeds and see what are those companies. So VC funds for us are the lens through which we see a world of impact investing and VC investing. And they give us the evidence that this is the world and come along with us, really. And same with impact investors as well. And then we go along with them, take principal bets with them, and see which one of those where we can nurture towards a later stage investing, where we understand the business better. Otherwise, it's a finger in the air.
Makes sense.
It's very hard. Yeah, sorry.
All right, Ruchira, you had actually triggered this question in my mind, and then I saw an audience member pinged about it. Would love your thoughts on this.
Thank you, Mark. So I'll answer from a perspective that actually cuts across my direct investing role and my VC fund investing role. I think Srini made some very important points as they pertain to VC funds. But the question on valuation and paying up too expensively at the beginning applies to both. And for us, I think being a DFI and the fact that we have some kind of instrument flexibility helps us. So when we found things too expensive right now, because look, it's a lot of the tech world, you can't, in tech assets, you don't have a crystal ball, don't know how the business model will evolve, how the adoption will evolve. You can only see maybe 6 months out. In those situations, doing some kind of a convertible and waiting it out till we have more confidence in price setting has helped us. In some situations, maybe paying up with some kind of anti-dilution, even there have been cases where I've taken a full ratchet anti-dilution protection, have also helped us, at least allowed us to be there. And then in cases where we felt that the instrument flexibility didn't work, but we have to pay up, then we post paying up, work with the CEO and the management team on value creation. Because we said, in order to make this price right, I need to help you value create. And that we do with the help of our advisory departments. All DFIs, most of us have an advisory department which comes in to structure projects and do, whether it is around, market penetration, new product launches, cost stuff. So different elements of value creation with the help of our advisory team. We are also actually recently IFC has hired a global AI specialist. And that's because we've realized that data mining and deep learning are going to be value creating levers. So we help these companies with value creation using tech as a lever. So all of that allows us to enhance the chances of success. And I think once the success outcomes are enhanced, then paying up 10% more or less will not matter. So I'll give the Baiju example again. I entered at a valuation about 400 million. Today, the company's primary, that last round primary was at 10 billion. So whether I paid 400 million or 500 or 350 wouldn't matter at all because the current valuation is 10. So if you can do that kind of value generation, then a little bit of premium wouldn't matter. It's when the value creation runs short and it's a moderate success is when it pinches you to have overpaid. I'll pause
Understood.
there.
That was a great answer. And Jaap, you have the final word on valuation. So would love your perspective on the environment that we're in and how FMO sees it.
Well, I've not a lot to add. I think the valuations are just crazy. A market which is fueling a surplus of money, and I think that's also due to the fact that Europe, Japan, and the USA are piling up a lot of debt because they have to take care of their population. So they are printing a lot of money, and this money is just looking for a return because you don't get the return on a government bond.
Nope.
Central banks are buying it. So there's just a surplus of money which is in the system and floating around. And there is an opportunity in tech solutions. So and to find that demand and ask is difficult. So there's a lot of money available which is looking for the best opportunity. So I think it's hopefully it will last, but I don't think it will last. At a certain point of time we will wake up and say, how much did we pay for all those companies? And
That's a while from now. So I want to thank. That's it for today, folks. I'd like to thank all of the panelists here who were absolutely terrific. Even when I cut down their time to 1 minute or made them answer questions on the fly. Want to thank the organizers of Prabhav and hope everyone enjoys the rest of the conference. Thank you very much.
Thank you,
Mark.
Thank you, Mark.
Thanks to you, Mark.
Thank you.
Thank you.
Bye-bye.
Thank you.